is so I've pitched this deal about 6 times in investor calls. I've done it live, and we actually also last week did a walkthrough of the entire property. So all of the GPs on the team had gone through all 106 units. We talked to as many residents as were available and around, and every time I pitch this deal, I just love it more. I'm really excited about the deal overall. The walkthrough was super exciting because the property is absolutely beautiful. The units that we walked through, were in great shape. The tenants were absolutely amazing. Some of the feedback that they gave us was, "Hey, look, we love this property." And then, you always want to ask, like, what would you improve? And one of the biggest pieces of feedback that we got was that the management company, if there was something wrong or broken, they were very slow or delayed or so. The opportunity at this property is so let's kick it off with the team. So this is the GP team. The team brings an immense amount of experience to the property. And one of the other things that this GP team brings, and that's Justin, is he has a construction and property management company. And what that does is it allows us to be vertically integrated. So we can take a property like this that's mismanaged and manage it properly and manage it for cost. So most of Justin's properties, he's been able to manage them at 35 to 40% below industry standard. And that is huge, right? Because we already know this property is mismanaged. And so with our property management team and construction team, we can come in at cost and really manage this property the way it needs to be to really enhance the returns for each of the investors. So I think a lot of that experience and that ability that's proven is really important as part of this GP team. Plus, we have all kinds of other expertise on the team, which really brings us a solid team that was very specifically put together to really be able to take down a lot of these properties. So let's talk about the actual property itself. So the Haven. So the property is a 106 unit property. It's a garden style property in Creve Coeur submarket of St. Louis. The property was built in 1990. So this is a hotel that was converted into an apartment complex. It was lightly renovated in 23. So when we did the due diligence, a lot of the units inside were lightly renovated. So that gives us kind of an edge because we don't have to do much on the interiors of these apartment complexes. Its occupancy rate is 94%. And one of the things we did during due diligence really validated that and past year's occupancy. And the property has sat around 90 to 94% occupancy over the last 5 years. So what that says is this property really has high demand and keeps its tenants on a long period of time. The property is a mix of 1 and 2 bedroom apartments. And currently, the rents are below market. So if you look kind of in the middle of the slide here, the average rents in this apartment complex are 1180. The property's current NOI is 870K, and that's a rent to income ratio of 11%, which again, it just shows the affordability of the actual area and the property itself. And then the property today as is cash flows. And so again, that helps with that risk profile and really protecting your capital. So this is kind of a 4-point slide to really show how we will create value at the Haven. So operating it, right? It already cash flows today. The tenant has proven demand. So like I was saying before about the occupancy, and then our operations, right? So we have the in-house property management company that is a proven property management company that will come in and really manage the property and continue to drive that tenant demand and potentially even get us to 100% occupancy. Um, NOI optimization. The expenses are a little out of control right now. The property isn't managed well. And so really coming in and optimizing the expenses. One of the things that we noticed is the tenants are all charged about a $250 flat fee for rubs. Basically, that incentivizes them to use as much energy, electricity, heat, AC as they want. And so, one of the first things that we would do is adjust that so that we could actually charge them more if they go over. Therefore, we would bring down the electrical and heating bills and AC bills pretty much immediately to really control that expense piece. One of the other things we noticed too is when we walk the property, a lot of the leases, I think it was about 10% of the leases had pet on their lease, and so they were paying the additional pet fees. But then when we walked the property, a lot more people had pets in their apartments than they actually had on their leases, and therefore we'll be able to upcharge those people who actually have pets and aren't paying those pet fees. We have some targeted improvements, so some of the stuff, some light interiors improvements, but because it was an old hotel, when you walk into the entrance, it's an absolutely beautiful entranceway, just like if you were in a hotel. There's a lot of room to do different things. There is currently a laundry, well, a couple washers and dryers there. We think that we can turn that into a laundry facility that dispenses, like detergents and softeners and stuff, along with vending machines, some TVs, and really turn it into a laundromat where we can charge some extra fees and get some extra rent. And that was also some of the requests from some of the tenants that we spoke to, that they go to the laundry room and there's only four of them there and they're all used. So really giving them more opportunity to come together as a community. And then the capital discipline, really just we did a very good job with managing the reserves, with our leverage right now from a standpoint is a 70% loan to value, and then really making sure that our investors come first and that we really cover and make sure that we're protecting their capital. The other piece that we like to talk about is really the break-even analysis. So what's worst case scenario, right? How are you guys protecting my capital, right? So what this slide here shows you is worst case scenario, we drop all the way down to 66% occupancy. We can still pay the bills, and there's a slight little bit of money that we could return to our investors, but your capital is still safe. And so this is truly catastrophic, right? We'd have to drop almost 30% in occupancy. So that means we would have to lose like 30 to 35 residents that are already there, which is highly unlikely. And even if we did, we would still be able to return your capital. It's still protected, and you might get a slight return on your money, even in this worst case scenario. So we like to show this just to say that we actually underwrote for this, because who knows what happens. But again, worst case scenario, which is very highly unlikely, we could still pay bills and keep your capital safe. So how are you guys going to do this? So this is kind of a plan on how we're going to execute. So 65 to 75 days, we will have the property cash flowing, right? Post-close execution. So this is where we'll start to transition the property management team. We'll bring our folks in. We'll really start implementing our efficiencies, and then start our CapEx program, which will be a full year of really fixing up that center unit, looking at different units, turning different units, updating, marketing, and making sure that we're really starting to execute on our plan. From there, we start distributions, like I stated, 1 quarter after we close. We move to operational maturity. So this is around month 12. So we've established ourselves, we've established our processes. We are really flowing now. Everything is working as planned, and we're really starting to optimize that NOI, and you'll start seeing your cash on cash returns increase. So the ultimate goal is just to stabilize the cash flow by month 12. And then finally, The goal is to hold the property for 5 to 7 years. So as we're stabilizing the property, we believe we should be able to do a refi right around year three, which will return approximately 70% of your capital. And then we will continue in the property, and you guys will continue to get distributions until we sell the property. We say 5 to 7 years because who knows what the market looks like at that point. So we want to make sure that we're doing the best for our investors. So if year five is the top of the market and we really have an opportunity to sell, we will. If it's not, we'll potentially hold it a little longer, and so that we get the most back for our investors. So the best part, what are our projected returns? So from a cash on cash standpoint, the projected reserves are between 7 and 8%. We believe your return on investment over the life of the deal sits between 23 and 26%. Huh. That would be an equity multiple of 2.2 to 2.3x and an IRR of 19 to 20%. So this is over the life of the 5-year hold.